In this webinar recording, we cover the following things. We look at successful trading signals that brought over 400 pips last week. We look at entering a live trade this morning. We look at risk return ratios. We look at stop sizes, and we look at reverse volatility. Broker data errors occurred last week, really serious ones, and we discuss on how to fix them and a lot more. Okay, in today's webinar, it's Monday, 2 o'clock in Australia. So the market's been open for about 4 to 5 hours, and there hasn't been any major gaps in the market. And on your screen, you can see my favorite analysis charts. Okay, there we go. Now everybody can see the charts. Thanks for that reminder. Okay, so I'll just review what we were chatting about earlier. As I mentioned earlier, the green dots represent last week's chart analysis, and I've got blue dots that represent this week's chart analysis. Now you can see there's no blue dots on these charts because I haven't spotted anything that is worth trading at the moment and these are the daily charts. But if we have a look at these daily charts, and you can see all these green charts actually resulted in some fantastic moves in the market. Those green dots caught some really good ones. And just taking the pound as an example, the pound's price went straight down and straight up, no trend line violation opportunity there, and that line over there is in fact the entry line, and if you entered there, the price had run almost 600 pips in one direction, and most of these trades would have been actually quite good. If you look at that one over there, we've got quite a good move there, 300 pips. That one over there, let's see, 240 pips. So there were some really good moves caught in the market by just using a really basic signal, which says if the RSI cuts over the 50 line, then you trade. Now let's have a look if there's any opportunities at the moment for that, for not only 50 line crossovers, but trend line violations. So at the moment, all of those crossovers are actually playing out, or they are starting to reverse. So you can see there's already a hook on the RSI hook there, but it's not a signal at the moment. So there's no blue line there. We'll just keep the green lines there just to remind us of that. And there was no green line, no green over there. Oh yeah, that's a very tricky currency at the moment. Not trading that too much. There was one that didn't quite make it, and there is no. We said we're not going to trade this one, and the reason why we didn't trade that one is when you're using RSI trend line violations or even 50 line crossovers, you have to have a healthy movement of the RSI. It has to go oversold, overbought, oversold, overbought, oversold. Now you can see it went oversold here, but never went overbought. So what I recommended there with that cross is don't trade it because it hasn't got a healthy movement. And in fact, it shows you that the crossover didn't really result. It actually went sideways after that. And let's have a look. This one was quite good, and that one, but there's nothing brewing at the moment. So we'll move on to the 4-hour charts pretty soon. If you spot anything, just shout, and I'll have a closer look at it. We're going to look at the 4-hour charts, and here again, the greens were particularly good on these breakouts last week, and we have 3 blues, which is signals that are just happening right now. So there's a signal happening right now, a trend line violation on the RSI. It hasn't happened quite on the price chart yet, and that is why why that is the case is the RSI is a leading indicator, so it tells you about trend line violations before they actually happen on the. And here's one that is almost a perfect setup: a trend violation, a trend line, a divergence, should I say? And we'll just make that clear. There's the divergence, there's the trend line violation, and it's gone oversold, it's gone overbought. So that's a valid signal. And in fact, you can see there is a deal right there with 2 lots going right there. And we'll talk about that deal later on. And then there's another one, exactly the same thing here, oversold, overbought, via a divergence, and the divergence is a short one. It's only really at the top here that the divergence is happening. And not doing very well over there, and there's the divergence. So here's another one happening. This one a little bit far from the 50 line, but certainly that's a setup for. So we've got 3 setups. We've got the pound New Zealand for a sell there, the pound yen for a sell there, and the pound over here for a sell. So the pound is definitely being backed for a sell per this analysis. And I've already entered the pound yen deal over there. There you can see it's entered. It's most probably slightly positive at the moment. And there's my stop, pretty far from the price action. And there's my target, which is on a support and a historic support and resistance area. Oh, good question that's just come in. It says many charts have the same profile. Now, if you look at this, there's one, there's the same profile. It's a hockey stick type of profile, we call it. And there's a reverse hockey stick, reverse hockey stick, reverse hockey stick. So the question is, which one do you, if you have 6 signals that actually are happening at the same time, which one are you going to trade? So in the corner here, you can see that there's a little number 61, 62, 46. Now, why I have those numbers there is that is in fact an ATR reading. So that's the average ATR over a certain period. And let's go and have a look at that particular indicator that I'm using. It's the ATR monitor, and I'll just show you the input. So I'm reading the ATR over a 14-day period. So it's saying, what is the average volatility as measured by the highs and daily highs and lows, or in this case, if we're looking at the 4 hour, it's the 4-hour candles highs and lows over the last 14 candles. What is the volatility? That's basically what that measurement is. So it is saying the volatility was 119 pips compared to 61, 70. So the answer to your question is I in particular go for the most volatile currency. If I see 6 similar setups, I go for the most volatile currency, because that's going to give me, firstly, the breakaway from the entry point will be faster, and it will give me a more potential in the actual trade. So a 40 pip. If the average candle is only 40 pips for this one, and you're going for 120 pips, you're going to take a very long time. This one, the average candle is 120. So to do 120, it could be done in 1 candle or 2 candles. So volatility is, and that is in fact why I have that number there. And here I've entered a trade, the pound yen. Reason why I've entered the pound yen and not the pound is, firstly, volatility is higher. This is selling the pound. That is also would be selling the pound. The yen is also going down. You can see it's in a strong, and that's why I've chosen to sell the pound yen, and the volatility is higher. The highest volatility around is the pound New Zealand, 186. That's by far the so if you take a trade there, you must make sure that you've got almost a 250 or 300 pip stop, because the volatility is high, but at the same time you'll get quite a lot of movement out of that particular trade. The other volatile currency, which is a bit deceiving right here, but it is very volatile, is the euro Oz. So if I see for instance a trade happening on the euro and a trade happening on the Oz, their combined volatility is 70 plus 60, so that's 130 pips. Here I'm getting 170 pips volatility by trading this one, so I would rather trade that one. Okay, yeah, thanks. You seem to be happy with that answer. Okay, so basically this is the analysis for today. Are we saying here are potential trades on the pound New Zealand, the pound and the pound yen, which I've already entered, and that is it. I have looked at the channel trading. Again, the channel trading has been quite good. The other reason why I entered that trade, although this is not a channel trade, I must just point out this is a really poor channel trade, but it's that support area there that I am prematurely saying I'm pretty sure this will be violated and hit my target down there. So that's another reason why I've entered that trade. I have looked at all the others, so I'm not going to go through each one and tell you why I didn't take that into account. But those three blues. Let's see if I've got anything on the. See, here's another really non-horizontal support region that looks like it wants to crash over, wants to sell. Let's have a look over here. Again, non-horizontal support, a trend line violation that looks like it wants to sell, and that's exactly that. That's how one blue, and that's the other blue, and here's the other one that has already broken through. That's why I've entered the deal. I basically drilled down to the 1 hour to refine my deal, and there it is. And you can basically see it there. Let's see if I can see. Okay, so there's the deal details. You know, there's the entry price, there's the stop I've got, the target I've got, and I will have a following stop of about. When it hits about 80 pips positive, I will bring in a following stop. You can automate that following stop also, so that is possible. But certainly that deal seems to be taking off quite nicely. All right. Any further questions at this stage? Because at this stage, what I'll do is I'm going to show you a whole lot of just interesting stuff, but nothing particular to what's happening in the market at the moment. I think one of the things I haven't shown you yet, let's see if that works. Okay, yes, it did work. Is the indices. I'm following them very closely because they reflect the stock market movements, and you can see there was quite a bit of a fight back last week. These are daily charts. Quite a bit of a fight back last week, but and it went down late last week again, but now it's fighting its way up again. So most of the charts have two blue candles. Two blue candles, which says that there's more confidence coming into the stock market, and the prices are starting to rise. But certainly this looks like a consolidation area that might stick around for a very long time. And we've been trading these using the grid trend multiplier. This consolidation area is quite good for grid trend multiplier trades. All right, so that I haven't shown you. Okay, so let's have a look at anything else that might be interesting. Okay, now what happened was these charts that you see now were not my normal analysis charts for this session. I used to use these charts over here, which look very similar because those are the ones that I used to use. But look what happened last week, and this is just a warning that these kind of things can happen on live accounts, and they can destroy trades quite badly. Here's an incredible spike. I mean, it flattened the whole chart completely. That happened last week. Now, this is an artificial spike that happened on quite a few currencies. And what this is, it's just a glitch in the data feed. All the brokers buy a data feed from their liquidity providers, and this was a glitch in the market. And now to show you this, let's have this is the yen monthly. I don't know why I'm looking at the yen monthly. Let's try the 4 hours. So this is the 4 hour. Still, the spike is so big that it's basically destroying the rest of the chart. So how do you fix this? Now, this is the yen 4 hour. So I'm going to show you how you fix it. You go into Tools, History Center, and it'll bring up the History Center like that. Then we go to, we were looking for the yens. Let's see if we can find the yen here. Okay, the yen, there we are. So we go into the History Center, and the chart that's the problematic one is the 4 hour chart. So we go into that, and now we've got to find the glitch. So all of that looks fine. We just go down, and see if we can find, oh, there's the glitch. Okay, so what's happened here is that the decimal point jumped 2 places. Okay, so how do we fix that? So we just go in there and we edit it. We go edit, and it brings up a box like that. And we say, all right, this is clearly wrong. We want to edit it. So we go 0.6170. So that's basically fixing it up. But it's saying, no, the high is wrong because the close was higher than that. Now, quite honestly, I don't know what it was, so I'm just going to put a value in there that is higher than the close. So there we are. We've got a value in there. I'm going to just make it higher like that. Okay, so now we've fixed this data because it's actually saying, look here, I'm happy. That's a proper candle. So you say okay, and you close this, and oh, all of a sudden the yen chart is fixed. That's what it should look like. It shouldn't look like that. It should look like that. So that's how you fix when something like this happens on your charts. That's how you fix the charts. Has anybody ever encountered this kind of thing, or did you know the process to fix the history? Let's see if anybody in the okay. No, thanks for that. Found it most useful. Okay, so that's a bit of something that's cropped up last week. I had to suddenly move all my charts because it took too long to fix every chart. I had to move all my charts to another platform so that I can do the analysis service. Okay, just another interesting thing, again, as I say, I'm just showing you interesting things at the moment, is, let's go down to the currency selection, if I can find it. Oh, this is the wrong one, so I'll just close it. I'll go to the one I'm using right now, and we'll go down to the currency selection. You can see I've got a lot of profiles, currency information. So we click on that, and this is an EA that basically gives you all the information about your currencies and things like that. Now, interestingly enough, so what we're saying is that the ATR measures the volatility of a currency and the trendiness of a currency. And we therefore have to look at the daily ATR, the weekly ATR, and the monthly ATR to get a feel of what's going on. Now, what is quite interesting, and I'll just sort that particular one on the weekly. And I'm pretty sure you can all see that on your screen. Okay, so let's have a look at the Euro Oz. So what the daily ATR of the Euro Oz is 550 pips. So it's saying the Euro Oz has traveled 550 pips on average over the last 14 candles. It's traveled. That's huge volatility, huge volatility. But then, if we look on the weekly basis and says, okay, I'm now looking at the weekly candles, the last 14 weekly candles. Let's have a look at the volatility, and that volatility is 520. The interesting thing about this is that the daily volatility is much higher than the weekly volatility. That's very unusual. That normally the daily is a lot smaller than the weekly, but in this case, and in many cases, if you look down that list, the daily volatility is bigger than the weekly. And then if you even look back, the daily volatility is bigger than the monthly volatility. So in other words, if we looked at the monthly candles for the last 14 months, that currency only averaged a range of 500 pips on a weekly basis. But we are experiencing daily volatility of 550. Now, what this is basically saying is we are experiencing abnormal volatility in the market. The market is not normal. It's just another confirmation to say that the market in general is dangerous to trade because it is trading under abnormal conditions. Now, again, as I say, this is an interesting observation, but certainly it is something that I look at, and you know, it confirms the abnormality of the market. Just to show you how this particular chart works. Oops, what happened there? Oh, something happened there. Oh no, it's right. So what we try and do here now, you see this particular currency, the euro franc, is normal because the daily ATR is smaller than the weekly ATR, and the weekly ATR is smaller than the monthly ATR. That's more or less normal. And what we then say is, if you take the monthly ATR and you divide it by the daily ATR, you get a trendiness factor, because it says this currency trends 3.7 times. The daily volatility is 3.7 times smaller than the monthly volatility. So in other words, it actually is trending pretty a lot. Whereas if we look at and I'll just sort this out again, if we look at the Aussie, which we've just looked at, it's actually saying that the daily volatility is bigger than the monthly, and therefore that factor that was calculated is 0.9. So which is almost, you know, it shouldn't be possible, but it is. And it's actually saying that although the volatility is high, the trendiness is actually quite low. It's just a funny concept to get wrap your mind around. Anyway, there's a whole lot of other stuff that this EA provides regarding currency selection, and that's those are some of the things that we look at. Let's have a look if there's anything else. All right, I think that's probably enough for today. Unless there's any new questions that are coming in, I'll give you a few seconds to consider any new questions that are coming in. But I think we've done pretty well today. We've looked at the market. We've identified 3 possible trades. I'm actually trading the one at the moment, so I'm committing myself to that particular trade. As you can see, I'm actually trading a live account of that's 23,000. So it's quite a big commitment. I'm risking almost $500 on that particular account. That might be something worth showing you. And I'll quickly just show you this bit of odds and ends, and that's what I'm doing today. I'm showing you odds and ends, but it might be things that you might not have seen before. Let's have a look at that particular trade. I'm going to just drill down, and I can actually use this one. I'm going to just drill down to the 15-minute. Okay, so here we are. We've got the 15-minute chart, and it's showing the stop, the target. You can see my stops are a lot bigger than my targets. That's the way I trade. But that doesn't. But my risk is calculated by the stop size. So I'm risking about 2% on this particular trade. But the one thing is that if I wanted to move my stop, I could just click on here. Let's see if I can get it to activate. Oops, no, I don't want that to happen. I want to actually manually move that line. Let's see if I can get it going. Okay, there we are. No. Okay, there. So I can manually move the line up and down any way I want. But have a look on the left-hand side of the screen. It actually gives you information. It says where the line is now, it is minus 284 pips, and in dollar terms, it's 528. So I'll move it down. Then it says, oh, this is only 162 pips, and it is $297 worth. So you can actually move the stop line to the dollar value that you want, that you're happy to lose. So I must probably about 280. This must probably where I want to be, and there we are. 270 is good enough, and I just release it. And now I know my stop value is $470. Now, just a quick census. It appears that your risk reward is under 1. Can you explain? That's the way to trade. I don't know if you've been taught otherwise, but that you must trade with big stops and small targets. In a volatile market, certainly in a volatile market, you have to trade with huge stops and smaller targets. It's quite normal to trade that way. Have you been taught otherwise? What you'll find is that your risk reward, that your success rate would be very low if you. No. Yeah. It's actually a contradiction. So in other words, if you trade with big stops, your success rate will be very high. If you stay with small stops, your success rate will be very low. So the two cancel each other out. So I've just found trade with big stops gives you time to hedge trades, and I don't actually hedge. I trade I trade a different currency to the one that I'm trading, but in a contrary way. I actually only trade signals that actually make sense. So I don't just go and hedge. I'd say, oh, hang on, this signal is giving me a buy on the pound. I'm going to trade that one. So within that transaction, if you've got a big stop, you can actually have a miniature trade within that transaction on another currency. Like this is the pound yen. I can go to the pound USD and have a miniature transaction in there, make a profit, and therefore reduce any potential loss that goes on. And then I can do the same thing over. So this creates groundwork for me to play with other transactions. So there's more to the trading than meets the eye. And that's why big stops are very important. I think this stop is 280 pips. 250 pips. It should be 280 pips. But big stops are nice. Now, and again, big stops needn't increase your risk, because if you're risking 2% of your account and you want to stop a 50, you're going to have X number of lots. If you're risking 2% and you want to stop a stop of 300 pips, you then just adjust your lots so that whenever you lose, you only lose 2% of your stake. So if you've got that choice, I would always go for the bigger stop, because I'm going to lose the same amount of money, but I'm going to have more freedom within my trade to play around and give the transaction lots of room to make up its mind where it wants to go. that's another reason why big stops are very good. There are times when small stops are appropriate. You know, if you've got, like, for instance, here's a semi channel. It's not quite a channel, but let's say that's a channel, and you feel that bouncing point is an incredibly strong bouncing point, then you needn't have a 300 pip stop. You can actually then have a 50 pip stop and go for 150 pip target. But it's a very specialized, you need to be very, and you need a lot of confirmation that that's a turning point. The channel line on itself needn't, you're going to need horizontal, you're going to have the RSI is going to have to confirm that there's a divergence. You're going to have a lot of confirmation to have small stops, whereas, as I say, bigger stops, it gives you a lot more freedom and chances of success. Okay, thanks for that question. A very, very good question. And also, it does illustrate the point that a lot of people walking around with a lot of baggage, where they were taught your stops should never be bigger than your targets or something. They might be taught that, by somebody in the first course that they did, and that would be something that they walk around with for the rest of their lives. And and the reason why, so I'm going into this in detail because it's quite important. The reason why I see this as important is that we have tested hundreds and hundreds of Forex trading techniques, and the minute you increase the stop on some of these techniques, they become highly profitable. It's just as simple as that. It's a statistical thing that we've built up over the years, is that if you want to increase the profitability of a trading technique, increase its stop. As simple as that. Okay, right. Thanks very much for those questions that have come in today. Really enjoyed the feedback and the comments that have come in, the questions that have come in. And from me, Alex Deploy, cheerio.